Good morning. Welcome to our regular second Saturday presentation. As usual, the first presentation will be on current market scenario, followed by recommendations. Then we will try to clarify your queries. If you see for the last 2 months, large cap indices, both Nifty and Sensex has been on sideways. For the second month in a row, Nifty and Sensex has given marginal negative returns. One of the main reason why the large cap indices are underperforming is due to Reliance and Bank Nifty. Reliance has been on sideways for some months, whereas if you see the Bank Nifty, they are also on sideways. Majority of the stocks like HDFC Bank, Kotak Bank, ICICI Bank, Axis Bank, they are all are down more than 10% from their recent highs. That is why Nifty and Sensex has been underperforming. But if you see mid cap and small cap indices, both has given positive returns in the last 2 months, in spite of large cap indices giving negative performance. There is plenty of action in the broader market, in spite of muted large cap indices. And if you see daily, some sectors has been doing well. Yesterday it was a pharma day where almost all pharma stocks went up very sharply and surge in COVID cases. Day before yesterday it was steel stocks, and before that it was IT stocks. So daily some action is happening in the market in spite of indices, nowhere moving indices. On institutional flow, if you see, means it has been muted only. Foreign institutions, they are not either buying heavily or selling. Even yesterday, if you see, they have sold some shares, but big buying is not happening from institutional side. As usual, you know that generally the domestic institutional, they used to do what the reverse of what foreign institution used to do. They used to counterbalance the foreign investors. If foreign investors were heavy buyers, means that domestic institutions used to be heavy sellers. Suppose if foreign institutions were heavy sellers, means the domestic institutions will be buyers. But in the last 1 month, if you see, since the foreign institutional flows were muted, domestic institutional flows also muted. So overall, no major inflows or outflows from institutions in the last 1 month. So then the next the next the next trigger for the market will be results. From next week onwards, results will start coming in. So on 12th, TCS is going to come with results. On 14th, it is going to be Infosys. On that day, market will be an holiday. No trading will be scheduled on that day. On 15th, it is Wipro. So from next week onwards, market will start focusing on results. If you see global markets, they are extremely bullish, particularly the mother of all market, US. If you see, even yesterday, Dow Jones went up by 300 points and they hit an all-time high. So world markets, there is a huge positivity is there. So, and if you see the domestic market, plenty of action is happening in the broader market, whereas on the index level, market is overall on the sideways. And if you see in the market, it's a typical bull market. What we have seen in the last 30 years, in bull market, almost every stocks used to go up. The same thing is happening now. One day one sector will go up, the next day another sector will go up, like sector rotation will happen. So on an everyday basis, some stocks will always will be active. That is what we are seeing now. So initially what used to happen in a typical bull market is that a large cap and good quality stocks used to go up, then mid caps used to go up, then followed by small caps, then poor quality stocks, then finally will start going up very sharply. We haven't reached that stage, but still it's a typical bull market. The only difference what I see between last time and this time is that generally in a bull market, retail investors used to be very active, and plenty of buying and selling happens from the retail investor side. But that frenzy is missing now. So retail investors are very cautious. They are participating in IPOs, whereas on the broader market and a secondary market, they are extremely cautious. Some of them have even sold and are waiting for big correction to re-enter it. So in a typical bull market, retail investors used to be very active, but this time they are very cautious in spite of market seeing huge positive action in many stocks. So that is the only difference I'm seeing between last bull market and this bull market. Generally, historically, what has happened is that retail investors' action used to be at the peak on when the market is at the peak. So the missing retail investor action indicates that we haven't reached the peak. The hot news now is that India is on the second COVID wave. It was expected that India may escape from the second COVID wave, but it doesn't happen. As suggested in previous epidemic, the second COVID wave has hit India also like any other country. Now the daily case has been surging very sharply. Generally, between first wave and second wave, it used to be the number of daily cases used to be multiple times. If you take US, it was almost 5 times what was the daily cases registered during the first wave. The second wave daily peak cases will be the almost 4 to 5 times that of first wave peak cases. So if you see that, if you take that example, means there in India almost 1 lakh cases were registered as peak during the first wave. Now yesterday 1.45 lakh we have got number of cases. So as per the US example, if you see, means then almost 4 to 5 lakh cases daily cases India has to reach for the second wave to get peak. That means that the second wave has just started because we have reached only 1.44 lakh cases. That means no number of cases, daily cases is likely to surge in coming days before it falls. The second question that arises on everyone's mind is that whether market will see fall like what we have seen during the last year, because the last year when the COVID hit the world, market fell very sharply, and many of the retail investors, even daily I'm getting 4 to 5 calls that whether the market will fall like what we have seen in last year when the first wave came. But my sense is that uh, market our market will solely depend upon the global markets. If you see Dow Jones in this chart, this is the number of cases in US. This is the first wave and this is the second wave. Whereas if you see Dow Jones, if you see during the second wave, Dow Jones never reacted very negatively. In fact, in spite of surging its second wave cases, Dow Jones actually keep on going up only. So if you take that example, means stock market behavior is somewhat independent of what number of cases are there. So global, our market may underperform to global markets if cases surge, but it won't fall like panic like what we have seen last time. We may underperform. For example, if global markets goes up by 4 to 5%, means we may be either flat or marginally negative, but we won't fall by 10%, 20% like that. What we have seen in last time. Only when global market starts seeing sharp fall, means then our market may fall. But because of COVID cases surging, our market independently won't fall. It may underperform global markets, but we are not going to see huge fall in our market because of surge in COVID cases in India. And now vaccination has started, so a lot of discussion is happening in media whether India should have avoided exports or it should have been used for our Indian citizens, like that. Lot of debate is happening. But if you see, if you see India, if you see in our country, what many people were hesitant to take vaccine. That is the reality. Now only after the cases started surging, many people are now going to hospital and taking started taking vaccine. But before that, 1 month, 2 months back, if you see, means many people are hesitant to take vaccine because of some negative action may take place if you take vaccine like that. So now after the cases start surging, now many people are going. We expect that because of huge population in our country, vaccination, even though we are the highest vaccinating country in terms of number of doses, because of high population, our percentage is still low. It will take some time because a country like India, where it is very diverse and hugely heavily populated, it will take some time to get vaccinated. So this start has been taken 10 days back. And if you see that the countries where number of months it will take for all citizens to get vaccinated, And if you see that India will take almost 40 months, it was taken 10 days back, but we feel that the vaccination will get speed up in coming weeks. That means it won't take 40 months. It may take at least 1 to 2 years for all citizens to get vaccinated. But if you see countries like UAE and all, already majority of the population has been vaccinated. It will take another 4 months to get completely vaccinated. For UK, it is 6 months. For USA, 7 months. For Canada, it will take 18 months. For Mexico, it will take more than 40. Similarly, for Indonesia, it will take more than 40 months for people to get completely vaccinated. But my sense is that in the next 4 5 months, many countries will get vaccinated, and also new vaccines will get approval. So the next 6 months, 7 months, I feel more than 50% of the global population will get vaccinated, and only question is that how many months the vaccine will give protection to the public. That answer no one has, but we hope that in 6 months time, maybe corona may become an history. The next big announcement we had in the global market is that the US President Biden has announced 2.25 trillion stimulus package. So the stimulus package is as per his election campaign. So before election, he told that he is going to spend heavily on US infrastructure and other sectors. So based on the election promise, he has put the stimulus package for voting. So it will take 5 6 months for it to get approval. So the 2.25 trillion though looks big, the plan is that they will spend the money in 8 years time. So it's not a single year spending money, it will take 8 years time. So per year around 250 260 billion US dollar they are going to spend for various sectors. And if you see the sectors where they are going to spend is the transportation infrastructure, where they are going to expand the transportation infrastructure, where 621 billion will be spent for 8 years. Similarly, for elderly and disabled Americans, 400 billion will be spent for improving drinking water infrastructure, broadband access, and electric vehicle infrastructure. They are going to spend 3 billion. For affordable housing and schools upgrade, 300 billion. And American manufacturing, to improve American manufacturing and R&D spending, they are going to spend 580 billion. So overall, the entire money comes to around 2.25 2.3 trillion, but the entire amount will be spent over 8 years. So the source of money for this is that US president has said that he is planning to hike the corporate tax from 21 to 28% in US. Actually, when Trump came last time, he reduced the corporate tax from 35% to 21 in 2017. So before Trump, the corporate tax rate in US was around 35%. So at a single stroke, he reduced it from Trump reduced the tax rate from 35% to 21%. He reduced in 2017. So from 21%, Biden is planning to increase to 28%. So some political against is there for increasing the tax rate. So we have to see how he is going to cope up with the corporates who are against this hike in corporate tax rate. So that is why it will take 5 6 months for the Biden bill to get passed. Because of the hike in tax rate, the resistance is there. He has to convince the people for hiking the tax rate, and it may take some time for the bill to get passed. But because of this stimulus package, steel stocks and all went up, commodity stocks went up, because there is a feeling that US will start consuming heavily because of their spending in infrastructure. And USA unemployment rate, if you see, means it is gradually coming down post COVID, but still it is nowhere below the pre-COVID level. If you see the pre-COVID level, it is less than 4%, the US unemployment rate. Whereas now, if you see, means it has fell to 6%, the unemployment rate. Still many people are unemployed in US, even though it is falling at a very rapid pace. But the unemployment rate is still nowhere before the pre-COVID level. So gradually it will recover, and they are expecting that it will take 1 more year for the US employment rate to fall below the pre-COVID level. And the US has announced this massive 2.25 trillion stimulus package for next 8 years. But when you compare it with China, if you see, means even though the amount looks a very big amount, but it has been spread over 8 years. So per year it will come around to 250, 260 billion dollar. If you compare with what China spends annually, if you see, means the amount actually doesn't look that much big, that it will trigger like a 2003 to 7 like an commodity consumption boom economy in US. If you see this American jobs plan, that is what Biden has announced now for 2.25 trillion. For transportation, he is planning to spend 620 billion. That means around 78 billion he is going to spend per year. Whereas if you see China annual spending for transportation, they are spending 522 billion per year for transportation. I mean, China has built a massive this bullet train network in their country multiple times than what US has or any other country in the world has, and they are continually spending money for their transportation. So the US plan is 78 billion per year, whereas China is already spending 522 billion per year in transportation. So it is just 15% of what China spends. The incremental spending by US by the US will be on American jobs plan will be 15% of what China spends. That is 522 billion China spending. And they are planning to spend 78 billion more. So it doesn't look a very huge amount. But if you see on the headline figure, say 2.25 trillion, it looks like a very big amount. Similarly, for clean water and high-speed broadband and community initiatives, the US they are planning to spend 81 billion, whereas already for China they are spending 62 billion in telecom, and for water conservation they are spending 170, almost 200 billion they are spending. US bill is around 81 billion. So if you see like that, means the headline figure looks big, but it is unlikely to make a big change like what we have seen in 2003 to 7, where China spent a huge amount of money for their infrastructure. When you compare that, means it doesn't look that much big amount. As far as commodity is concerned, if you see China is the one which has the power to dictate the commodity prices, whether it is steel or copper or any other material. If you take, means China, they are in the driver's seat. I will give two examples for that. If you take the refined copper consumption, then in 2019, refined copper consumption, which is one of the hot commodity now, where they are expecting huge demand in copper, mainly because there is an expectation that electric vehicle, they need electric motors. So all motors will need winding, which are made up of copper. So as well as the charging for charging infrastructure, if you want to create, means you need a lot of copper wires, because electricity is passed through copper wires only. And if you see in 2019, copper in 2019, if you see, means the copper consumed among the whole world, China has consumed almost 51% of what the entire world has consumed. China has almost 51% market share in consumption of copper. The next other country, if you see America, it has 12%. So the next country is not even 1/4 of what China consumes. Europe, all European country combined together, they consume 17% of global copper. Asian country, if you see 19, Africa and other country 1%. So if you see that China consumes almost 51% of global demand of copper, and the next second big player is way below what China consumes. So if China consumption goes down by 5%, it means the other country consumption, all countries consumption has to go up by 10%. China can dictate the copper prices, because if they either reduce their consumptions by marginally, or they increase the consumption by marginally, it will have meaningful impact on the copper prices. Similarly, if you see the crude, the same story. Among world crude steel production, China consumes almost 53%. More than 50% of crude steel is consumed by China. The next big country is India, where crude production, steel production, as India has the 6%, not even just 10%, slightly above 10% of what China consumes. So the first player and second player, if you see, means there is a big difference between the market share. And if China reduces their consumption by 10%, which is almost equal to 100% of what India produces. So China is in a driver's seat as far as metals are consumed. If China, the time to time, they tend to increase the export rebates for steel, because for exporting steel they may rebate, government may give subsidy. For if they increase or reduce means it will have a meaningful impact on steel prices, because China has the almost more than 50% of their global steel capacity. So China, if they think to hike a commodity means they can make it. Similarly, if they want a commodity price to fall means they can do it, because they have almost 50% of their market share. So whatever commodity it is there, it is China which is the deciding factor. And if you see the world largest economy, I have plotted it. The first one is US, where they are the 20 trillion US dollar, 20 trillion US dollar economy. The next biggest player is China, which is 15 trillion. Almost 30% difference is there between US and China. Then after that, it is Japan, 4.9 trillion. Then it is Germany 3.7, UK 2.6, then India 2.5, then France 2.5. So India is on the sixth largest global economy with 2.5 trillion. So if you keep aside US and China, the other countries before India, if you say, means Japan, which is at 4.9 trillion, they are having a population on 12, and then the 12 crore, and the population has been continuously coming down. Their population, and most of the population and aged population, and we expect the US Japan economy is unlikely to grow heavily because of their demographic issues, more aged population and population growth on negative side. And Germany, if you see 12 crore people are there, they may grow meaningfully in coming years. If you take UK, just a 6 crore population are there. Even if France, if you take around a 6 crore population are there. So Japan, UK, and France, their economy may not grow on a rapid pace, mainly because of the population constraint. Very small population they have. Whereas if you see India, we have almost 136 crore people are there. China has 139. So within few years, India will become the largest populated country in the world. And the, among large economy, if you keep aside the US and China, India is the only country which has scope to grow their GDP meaningfully in coming year. And in the next in the next decade, India will be on the third largest economy in the world. India can beat Japan and Germany in coming years, mainly because Japan don't have the demographic issues. Japan has the demographic issues, where German they can meaningfully grow, whereas the other countries, because of a lack of population, they may not grow much. That is why many FIs are betting on India with a 10-year view, 20-year view, mainly because of the young population we have in our country, and the scope of economic growth in our country. The Q4 results, which are going to come from next week, as I told in my initial speech, that Q4 results are going to be good. Majority of results across sectors are expected to be good. If you take IT, it is expected to be good. If you take steels, they are going to be very, very good. They are going to post record profits, mainly because of jack up in steel prices, not mainly because of the volume growth, mainly because of huge sharp increase in the steel prices. Bank, I expect results will be good, because most of the provisions are over. So majority of the results are expected to be good. What market will be focusing will be on the balance sheet, deleveraging of balance sheet. That will continue to happen in the current quarter also, and the strength of balance sheet will keep on increasing. So the only sector which is likely to be average will be tourism and hospitality sector, which will remain affected. Just it was started improving. Now in the month of March, we have seen that the Maharashtra started affecting. Now in April, the entire country is started affected by COVID. So tourism and hospitality sector will remain affected. And last quarter results will be somewhat better, but in coming quarter onwards, the results won't be good, because they may get affected once again. GST collection, it has been continuously good, and even in the month of March, we have seen record collections since the GST has been introduced. And if you see from the month of December onwards, the growth has been very good. In the month of September onwards, actually the growth has started. In the November month, it was somewhat flat, but after that, the growth has been very good. And there is a confusion happening in analyst mind that GST collections has been very good, whereas if you see the other indicators, what we are seeing is that some slowdown has been happening in the high frequency data. So this is the Nomura India Business Resumption Index, which is nothing but an index which used to track high frequency data. And it indicates how much business has resumed post COVID. If we see that in April there has been a sharp fall in the business, this Nomura India Business Resumption Index. It went to up to 98 in the month of February, and then Maharashtra COVID cases started increasing. There has been some slowdown started happening, and in the month of April it has come down again to 90 levels. So the high frequency data indicator indicates that some slowdown has happened in our economy, and we may see is some panic may emerge in people to not to go away or to avoid unnecessary venture outside. That may create some slowdown in our economy because of a sharp increase in our in our COVID cases. But that will affect our market. We don't think so. It may affect to a certain extent, but we are not going to see the fall we have seen like last time. IIP for May, it continues to remain muted only for the last 4 months, though it is an 1 month lag data. It remains muted for a few months. Generally, in some of the times like 2000 and all, 2007 and all, we have seen where IIP used to grow by 10 to 15%, mainly led by exports and domestic demand. But now we are not seeing that type of IIP growth. Either it is coming +2 or marginally plus or marginally negative. That is what happening in IIP data. PMI also, it has slipped a little bit from the high of 59. It has come to near to 55. So the high frequency data are indicating some slowdown in our economy after a sharp increase in our sharp rebound in our economy few months back. So what market is betting on now is the government program what they have announced during the budget. So in the budget they have told that in our union budget, government has told that they are going to spend heavily on capital expenditure. If you see that in the month in next year, government is planning to spend almost 2.5% of GDP for capex, which capex spending will be non-inflationary, as well as it will create a lot of jobs and it will create assets for the country, which will be very productive, unlike non-planned expenditure. So capex expenditure government is planning to increase to 2.5%. So previously, if you see for last many years, in 2011 and 20, in the last decade, if you see that the capex was continuously lagging below 2% of our GDP. But now in the budget they have told that they are going to increase heavily the capital expenditure program from coming years onwards. So that is giving hope to the market. So previously, where we have seen such a huge capex by the government is during 2003 to 7, where it was consistently above 2.5%. At that time, what was happened was that both public and private used to spend a lot of money. Now government is now planning to spend capex heavily. The private, we are going to see the private also will start spending money, because in PLI scheme where many companies have shown interest. Once they have private also starts coming to spend money means, then it will be a huge positive and it will be a huge economic generation for the country. So that is what market is betting on cement stocks, steel stocks, and international commodity, where the price depends upon the international prices. Whereas cement, if you take, it is a 100% domestic commodity, where prices are independent of the international market. So how government planning to spend? So in the previous chart we have seen that government is planning to spend heavily in capex. So how government is planning to spend heavy for capex is that through debt only they are going to spend. government is planning to take a huge debt. That means fiscal deficit will be very high in coming years, and bigger and through debt program only government is planning to spend. That is why if you see the public debt as percentage of GDP, it was on a constant basis between 2010 to 20, almost 70, 71 like that. In 2020, it went slightly above 72. But last year, because of heavy COVID spending, because of lower income and heavy spending by government, and because of this Food Corporation of India subsidy, which has been transferred to government account, the public debt as percentage of GDP has spiked to 86%. And if you see next year also, government is going to borrow heavily. The fiscal deficit is going to be high. Whereas as a percentage of GDP, it may come down a little bit, but still it is going to be very high as far as government debt is going to be concerned. So because whenever government takes high debt, means what used to happen is that the bond yield used to spike. So in order to calm down the bond yield, 2 days back, and RBI policy meet government, RBI told that they are going to buy a government bond from the market. Generally, in the previously, what used to happen is that open market operation used to do by the RBI, but this time they have told that it is going to be ad hoc. That means they may buy at any time as they like. There won't be any fixed program like open market operation. They may buy anytime as they like. Because of that reason only, rupee has weakened in the last 2 days very substantially, mainly because of RBI planning to buy the government bond. But on positive side, if you see, means almost our banking system has been cleaned up. So banks also are in a position to lend. And if you see the bank system gross NPA in the last 12 years, if you see, it was our NPA has come down very sharply from 12.4%, which was the peak in 2018. It has come to 7.5%. Now the NPA has come down very sharply in our banking system, which means that lower provision needed for banks in coming years. That means that banks are in a position to lend money. Similarly, if you see the ratio of rating upgrades to downgrades, it also has come down very sharply. In 2019, 2018 and all, if you see, almost for every upgrade, there used to be for every downgrade, there used to be an uh, for for every upgrade, there used to be a downgrade of 1.8%, 1.7 times of 7 times. But whereas if you see now, the downgrade has come down. Suppose, for example, if you upgrade 2 companies, the downgrade will be only 1 company. It is 0.5x. If you upgrade 10 companies, if you upgrade ratings of 10 companies, means they may downgrade 5 companies only. But in 2018 and all, if you upgrade 1 company, they used to downgrade 2 companies. So the balance sheet strength has increased substantially when you compare a few years back. So company balance sheet has strengthened very sharply in the last 4 years. And banking system, the NPA has come down very sharply, which means that the financial system has become very strong when compared to a few years back, which may aid for companies to go up for capex by borrowing from the banks. The other important factor which has to be watched in next 1 or 2 weeks is the monsoon forecast, because the monsoon has a direct impact on the rural economy. Even last time, if you see, means in spite of COVID hitting the country, rural economy never fell, because last time the monsoon has been very good. And if you see the last a 7 years monsoon, if you see, means 2019, it was 110% of long period average. So long period average, when you compare with 100 years of long period average, the 2019 monsoon was 110%, and 2020 it was 109%. So 2 years of consecutive good monsoon has rescued our rural economy in spite of COVID attack last year. And this year we have to see how monsoon will behave. IMD generally a few years back they used to come out with their projection on the first week of April. Now last year onwards they have slightly postponed their monsoon forecast, and we are expecting by mid-April IMD will issue southwest monsoon forecast how it will be. Even if we get a normal monsoon this year, our rural economy will continue to do well, mainly because the moisture in the ground has been very good, which will help Kharif crop. So from 2014 to 2020, if you see that this is the period when Modi first came to power in 2014. So 2 years, first two terms of his first 2 years of his terms, if you see, the monsoon was less than 90%, which is very poor monsoon. So that affected the rural economy very badly during his first tenure. So that is one of the reason why, if you see that during his first tenure, our economy did well as expected, because monsoon during the first 2 years of his tenure was very bad. Even after that also it was not a great monsoon. Only in the last 2 years monsoon is good. Now even if we get now a normal monsoon, it will be a big boost for our economy. Global models indicate that the first half of the monsoon will be good, mainly because we are having a neutral La Nina and El Nino conditions, so that will not have any negative impact on the monsoon. So the first 2 months are expected to be good, but after that we have to see what IMD is going to give its forecast. So once the IMD forecast comes, means some of the laggards like pesticide companies and they are the laggards in the recent bull markets in our time. For the 5-6 months they are not doing well, and if monsoon is expected to be good, these companies like fertilizer companies and the pesticide companies and rural related companies, they may start doing well. And one data, if you see, means this is the PE ratio of the NSE. NSE website, you can go to NSE website and BSE website, and you can see what is the earnings of the index. That is, if you go to NSE, they will put the Nifty valuation, what PE level Nifty is trading. Similarly, if you go to BSE, means they will put the Sensex PE level, Sensex price to book value, and many of them used to see that the valuations as one of the uh, uh, criteria for taking investment decision. So till March end, NSE what used to do is that they used to calculate a Nifty standalone earnings of the companies, and they calculate the PE ratio. So the PE ratio was used to be very high. It was almost 40 price earning ratio for Nifty companies. But from March 31st end onwards, from April 1st onwards, they shifted to the consolidated earnings. So because of that, what happened was that the Nifty PE ratio fell very sharply from 40 PE. Now it has come to the 33 PE, which is in line with the BSE Sensex level, which is around 34. Previously, we used to have 20% difference between NSE and Sensex and Nifty PE ratio, mainly because the Sensex calculates its PE ratio based on consolidated earnings, whereas Nifty used to calculate its PE ratio based on the standalone earnings. Now Nifty also has shifted to consolidated earnings. So the more or less the PE ratio of both Sensex and Nifty used to match now. Because of 40 PE, usually what used to happen is that media and all used to take the headline figures from the index website, and they used to put that valuations are very high. Even 1 month back, if you see, means I saw a newspaper article that putting that that Nifty valuation has crossed to 40, which is alarming, which is high. But if they have shifted to the consolidated earnings, means then the earnings would have fell to 33. And in coming quarters also, we expect the Nifty as well as Sensex earnings to come down very sharply, because the earnings is going to go up mainly is by the laggards in the last few years. If you see some of the laggards like Tata Motors and Tata Steel, they were the main dragging companies for the earnings for Nifty, because they used to show huge losses in the last year, in last few years. Now that loss is not going to come from here on. In fact, Tata Steel is going to show huge profits, and Tata Motor also is show from heavy loss. They may show either marginal profit or they will come into profitability. That means the PE ratio is to fall further from here on because of the laggards which were used to show losses. Now they are going to show profit, as well as from first quarter onwards. Last year the earnings was very bad because of country-wise lockdown. Now that base effect will come into in. So what I'm expecting that at the same index level, Nifty P ratio will fall below 30 in coming quarters. Fourth quarter there will not be a big change, but first quarter from next year onwards, that is FY22 onwards, we may start seeing that Nifty PE ratio will fall below 30 for the same index level. Mutual fund flows, if you see, means that after many months of fall, there has been some inflow into the mutual funds. 9,500 crores inflow has come, mainly because in the month of March, index has fell some 7-8%. That has aided some of them who are on the sidelines. They have put their money, as well as March is generally used to be a peak month for investing in the tax planning. So that also has aided some inflow into the mutual fund. If you see in the last year also, the March used to be a high inflow month. Previous month and month before March and month before after March, if you see, means March generally used to be a peak month. Even last year also, if you see, March used to be a peak month. So based on the seasonal factor as well as market fall, some inflow has come into the mutual fund after many months of net outflows from mutual fund. So now people are having concern. Now COVID cases are going up. Whether we have to exit the market completely or what we have to do like that. But if you see in Indian market, we have various sectors are listed in India. Unlike other countries, we have that big opportunity to select the sectors where we can buy. See, we have IT sector, which is independent of our domestic economy. They are 100% export oriented, and they depend on their order book and other thing. Even if COVID cases surges to 5 lakh or 10 lakh per day, the IT sector is not going to be affected. For pharma, it is going to be the tailwind if cases goes up. And even if cases goes up, it will be positive for pharma sector. Yesterday, you can see that pharma sector has done very well. And FMCG, which depends upon the number of populations and consumptions. And in the first wave of COVID, FMCG sector did not affected much, and we expect that FMCG may not show high growth or low growth in spite of COVID cases going up or down. Metals, some of the metals are directly dependent upon their global prices. Though the consumption is on India, the prices are dictated by global markets and global commodity prices. Only financials, it depends upon the Indian economy solely, and if because of some COVID action, the financials may get affected. So we have many sectors listed. We can choose our own sectors, whatever we like, and whether COVID cases goes up or down, we may see bull market in some sectors, irrespective of what is happening. Suppose if world market does very badly next year because of some reasons, means even at that time domestic sector doing well, means at that time financial sector may outperform. So we can choose our own sector based on uh, based on the things used to happen, and we have opportunity at some point in our in some any sector uh, in our market. That opportunity is not available to many other countries. India is the only country where we have a lot of opportunities to buy the sector we like. So whether COVID is there or not, we can choose our own sector, and we can play in our market according to the situation emerges. So no need to panic because of COVID cases surging. We have to choose the correct sector. That is the point we have to remember. Sector outlook, we have put two slides on the sector outlook. The one is the first sector outlook we have put is the IT sector. So what we are expecting and our reading from the research reports and from the company analyst meet and all that, short to medium term, the outlook is very positive for IT sector, because the order inflows has been continuously very strong. And if you see in the last 3 days, all major companies, TCS, TCS and Infosys, they have announced a big order inflows. ArcelorMittal has selected Infosys for the digitalization program. Similarly, for TCS, one big multinational company, they have roped in TCS for the digitalization program. And for small companies also, they are continuously getting very big order. So this indicates that short and medium term outlook is very positive for IT sector. Moreover, the last because of COVID came last year, many of them are working at home. Because of them, they have cut a huge, they have done a huge cost cutting measures. A lot of cost has come down. Similarly, travel cost has come down considerably, which is aiding their margin. Even the pricing pressure is there, they could easily able to absorb because of travel expenses has come down. Similarly, cost cutting through work at home, and all, they are going to help. So overall, for a short to medium term, the outlook is very positive for IT sector. And if you see the top tier companies, Infosys, HCL Tech, they are still trading at reasonable valuation. Among four companies, TCS, Infosys, HCL Tech, Wipro, four large cap companies are listed in India. CTS, which is a Cognizant, which is also a large top tier company, but it is not listed in India. It is listed in US only. It is listed, so we can't directly play. Majority of them cannot directly play a CTS company. So the among four options, Infosys and HCL Tech, if you see, the valuations are still attractive. HCL Tech is trading at the lowest valuation among the four companies, and Infosys reasonable valuations. And when the earning starts going, means the stock price will continuously will move up. Among mid cap companies, the valuation are a little bit stretched. Even though the business prospects has been very good, the valuations are a little bit stretched. Among them, we like Mindtree and Tata Elxsi are both these two mid cap companies we like. The valuation are stretched. So based on the now results, they will announce it in the next 2 weeks. We have to see, and we have to see the outlook given by the company. And if suppose any correction happens in these mid cap companies, means then it will be a good opportunity to enter it. The other sector where we are seeing a lot of buying happening is the steel sector, where a vertical rally happened in the last 1 month. So one of the reason why steel sector has seen huge rally is the international prices has gone up. You know that steel is an international commodity. So whenever the international prices goes up, means then domestic companies, they used to jack up the prices irrespective of whether demand is there or not. And because of jack up in international prices, domestic prices has gone up very sharply, and it is expected that the third or fourth quarter results will be very good, and the first quarter results also will be very good. And a near-term outlook is very positive, but for medium-term outlook, since it is an international commodity, the China is the one which dictates the price of steel. Suppose if China thinks that steel prices are very high and they want to reduce the steel prices, means if they increase their exports, means then very quickly the international prices may come down. So the analyst, the big analyst from Morgan Stanley and Goldman Sachs, JP Morgan and all, they track the China prices more closely than the and they will track what China is doing more closely for getting the outlook on steel. So no one has a clue of what will happen to steel price 1 year down the line, because now mainly the steel prices went up because of a supply disruption in iron ore and steel produce iron ore. And after 1 year, we don't know what will be the situation for iron ore. So the China is the one which dictates the prices of steel. So near-term outlook is positive, and medium-term outlook, one has to closely track what is happening in China for getting the whether steel cycle will continue or it may pass, or there may be some correction like that. And if you see domestically, backward integrated companies like Tata Steel and SAIL in large cap, they are better. They are in a better position because they have their own iron ore mines. SAIL have their 100% iron ore mines, captive mine. So they are fully protected from their any sharp increase in the iron ore prices. whereas the employee cost is very high. So if you take the companies, each company has some positives and some negative. For SAIL, it is fully integrated as far as iron ore is concerned, whereas they don't have, they depend upon coking coal for through import only. They are satisfying their coking coal needs, whereas for Tata Steel, domestic operations are fully integrated, backward integrated. They have their own iron ore mines. For coking coal, they have 30% integrate, 30% captive, balance they are importing it. Whereas Tata Steel Chorus, if you see, which is their European operations, they entirely depend upon the global iron ore supply for their iron ore needs. So each company has their own plus and minus. And if you see JSW Steel, normally they have got their iron ore mines in Odisha, but their cost of iron ore is extremely high because they have to pay. Recently only they backed their iron ore mines. They have to pay huge royalty for producing iron ore from that mine. So the cost of iron ore is much higher than what Tata Steel and SAIL has. But the employee cost is much lower for JSW Steel. When you compare with SAIL and Tata Steel, the employee cost is much lower for the JSW Steel. Godavari Power, if you see in the mid-cap category where they have pellet production, but they also have their own iron ore mines, and they are in a good position because of their own captive iron ore mines. So overall sector, if you see, means near-term outlook is positive, but you have to have a close watch on what is happening in the China, because they are the one which are the deciding factor of the steel prices. On events to watch, foreign portfolio investment flows we have to see, because they for the last 1 month foreign flows are muted. So we have to see what steps they are going to take on the domestic surge in COVID cases. And global markets, till global markets are good, our markets won't fall. We are not going to see any sharp correction. Suppose if any cases, if global market starts falling, means then we will also definitely fall along with the global markets. Q4 results very important to watch, because the Q4 results will give some indication for the, especially for IT companies and banking companies, because for banking results they will put their real NPA, because now Supreme Court has given verdict on their NPA front. So banks has to put the real numbers. Till last quarter and before that, they were not showing their NPA because of the Supreme Court verdict. Now the final verdict has come. Now the banking results will throw some surprises, some negative surprises in companies because of the Supreme Court verdict. So banking and IT will be very close to watch. And domestic COVID cases, we have to watch it very closely. The cases have started going up just now, and it will be almost 2 times, 3 times what we have seen first week. Thank you. Now,
welcome to the recommendations for this month. First, we are recommending ICC Bank. As you know, when the economy recovers, banking sector will perform the most. If you take the banking sector, there are two sectors like corporate banking and retail banking. In the section of corporate banking, the most good one are ICC Bank, Axis, and SBI. So we recommend ICC Bank this month. You can buy at this rate for a target of 635 within 6 months. Next one is, as you know, the pharma shares are going up for the last 1 week. Cipla is one of the good pharma stocks that you can buy, because Cipla is now entering into the European markets, also in US markets. They are mainly catering to the respiratory section of the industry. So due to this corona cases, most respiratory diseases are on the rise also. So Cipla is doing good for the last 1 month, and now it's crossing its main resistance levels around 850. You can buy at current level. Yeah. Next one of the biggest theme is digitalization in IT sector. So in digitalization team, you can buy top IT companies. One of the top IT companies is HCL Tech. it's trading at reasonable valuation of around 20 PE only. And the large cap Infosys and TCS are trading around 30 PE. So in case valuation also, HCL Tech is reasonably valued. So you can buy HCL Tech at current level and hold it for 3 months. The result this quarter result will be good. And also the coming quarters Q1 and Q3 of FY 2022 will be also good. So you can keep it for 6 months. Another company in automobile sector is Tata Motors, as Indian operations of Tata Motors is doing good. And also Tata Motors is going to enter in electrical vehicle value chain in a big way. From creating electric vehicles to powering stations, the Tata Group companies are going to create separate companies for the promotion of electric vehicles. So on that team also, Tata Motor looks good. So you can buy Tata Motor also at current level for a target of 370. Last one is Prince Pipes, the Prince Pipes mainly cater to the housing sector. So now after a long time, the real estate sector is looking good. So in order to participate in the real estate sector, you can buy either of the participants companies like pipe company, cement company, either company, or you can buy housing finance companies. So as a proxy for real estate play, you can buy Prince Pipes, which is going up, which has a good momentum also in the last 1 month. So you can buy as a mid cap play, you can buy Prince Pipes at current level. You see the March month's recommendations. L&T BPCL are trading a little bit from our recommended price. Infosys has gone up around 5%. Tata Power is also trading around 7% down. So these companies, L&T BPCL, Tata Power, are fundamentally good company. You can hold, and they will reach the target within 2 to 3 months. So you can hold all the companies. Our portfolio slightly underperformed the Nifty. Our portfolio has given negative return of 3%, while Nifty has given a negative return of 1%. That's all for today.